Good evening, and thank you for joining us. Tonight's webinar is Multifamily Real Estate Investing 101, a Passive Investor's Guide. I'm Gary Lipsky, President of Break of Day Capital. Our other host is Kyle Mitchell, Managing Partner of Limitless Estates. Our companies work together and focus on acquiring multifamily real estate investments that offer value-add opportunities. We look in growing markets for undermanaged assets to maximize investor returns. I've been a successful entrepreneur my whole life. I've started a nonprofit and eventually found my way to multifamily a few years ago. I've personally invested passively in over 1,500 units before I started syndicating my own deals, and I still invest passively. Currently, I have 170 units under management with Kyle, and we run a Phoenix meetup together. I also run a few other meetups in Los Angeles. And I know a bunch of you that are on tonight's webinar that have attended some of our meetups before. And if you haven't, we'd love for you to join us in the future. Kyle, why don't you tell us a little bit about yourself?
Hey everyone, I'm Kyle Mitchell and Managing Partner of Limitless Estates. And as Gary mentioned, we co-sponsor about 170 units, both in Tucson and Phoenix. And my background is in management, logistics, and operations. I had about 15 years of experience in that field before I went into multifamily full-time 2 years ago. The co-host of the weekly real estate podcast, Passive Income Through Multifamily Real Estate. And I also host several meetups here in Southern California and also in Phoenix, Arizona.
All right. So tonight's webinar, we're going to cover what a deal sponsor is versus a limited partner, what makes a good deal sponsor, ways to invest. We're going to talk about the offering, fees and splits, time frame and the business plan, different types of loans, a market analysis, and some of the key terms. So in the next 30 to 45 minutes, we hope you get a lot out of this. Kyle, why don't you take it away? What is multifamily and why?
Yeah, absolutely. And before I get started, if anyone has any questions, please type those into the chat box. We'll definitely get to those towards the end. Or you can also use the Q&A. We do prefer if you can use the Q&A, but either will do, and we'll answer all the questions at the end. So first, what is multifamily? Pretty simple answer, but we look for properties of 5 or more units that are multifamily. Anything smaller than that is considered residential. And anything larger than that is really considered commercial. The space that Gary and I invest in is 50 plus units typically, all the way up to about 250 units. But when we talk about multifamily, we're talking about 5 or more units. Why multifamily? There's a variety of reasons why we love multifamily. 4 of them are listed here, but there are several more behind that that certainly play into that. But one of the reasons is economies of scale. So multifamily syndication allows for people to purchase larger properties than they would otherwise be able to purchase on their own. And the great thing about that is you're able to take advantage of leverage and scale. So things like expenses for payroll, supplies, and equipment, they have a less of an effect on the bottom line the larger you purchase. Next, housing is a necessity. So the U.S. needs about 3.9 million units of housing today, and that number is only getting worse. And when I say they need that housing, they don't need new construction Class A buildings. They need affordable housing for Class B and Class C type properties for regular workforce housing. So they're not building that anymore. And it's very tough to build because of the cost of construction. And so when you have that much of a need and demand for housing, you know, it's tough to go wrong with multifamily, and that's one of the other reasons why we love this asset class. Another reason, backed by a hard asset, you can touch, you can feel it. It's not like the stock market. You know, you have no control in the stock market. You're not going to go into Coca-Cola and demand that they raise their marketing efforts or, you know, go change part of their business in order to get your stock up. And the great thing about real estate is you can do those things. It has multiple income streams, multiple expense line items that you can control. And then the other thing is that, you know, when your stock hits zero, you're done. You're out of the game. You've got to go back and you've got to buy some more stock. The thing about real estate is, you know, it's always going to have the value of the land on it. And if it does hit zero and you can hold the property and not sell it during that time, then the property is going to bounce back and you can bounce back with it. And the last thing listed here is tax benefits. I will say, please consult your CPA, but real estate can provide amazing tax benefits. And there's some new laws that have recently changed over the last 2 years that also allows 100% bonus depreciation in year one, which lends to even more benefits as far as from a tax perspective. But again, every person is a little bit different. It really depends if you're a W-2 employee, self-employed, real estate professional. All those can be beneficial for taxes, but you will need to structure yourself with your CPA accordingly. All right, deal sponsor and general partner. So what is a deal sponsor or a general partner? And really, they're the ones leading the team, finding the deals, as it says here, and really organizing the structure of the syndication from A to Z. And so these are a lot of the things that Gary and I do on a day in and day out basis. And I'll go into some detail into some of them. But number one, we find deals. We go out there and we go to the markets and we build relationships out there. We tour the properties and we find the opportunities out there. Assess opportunity and come up with a business plan. That's everything from, again, visiting the markets, meeting with brokers, touring properties, underwriting the deal, working with the lender to see what type of rate we're going to get, and what type of team we need to build on the front end in order to make it a viable option. We also put money up for earnest money deposit, hard money, reports, legal, lender. All these things are upfront costs of a syndication that I think a lot of people don't know that, you have to put in up to several hundreds of thousands of dollars of upfront money, which is your own money, in order to make these deals work. Typically, the earnest money deposit is anywhere between 1% and 3% that you basically have to put down once you're under contract. And some of that money goes hard. And what we mean by hard money is it's non-refundable after a certain point. And if we don't move forward with the deal, then that money is lost. Other things that cost money are, legal fees. You have your real estate attorney, you have your SEC attorney, and then actually you have your lender's attorney as well. So there are likely going to be 3 different attorneys that you're going to be paying to get this thing to the closing table. And there's other things like the third-party reports, whether it be an appraisal or the environmental study, things of that nature, a green report if you're going to go that route. So that's another thing that we do is we put up earnest money and upfront money for the deals. Third thing we do as general partners is we raise the capital to close on the deal. So on our last deal, Gary and I and our team had to raise about $5.7 million. And that comes with, being a general partner and a deal sponsor is we need to have an investor list and raise the capital to get the funds closed. Next thing is asset management. And this is a big one. And a lot of people, kind of skim over this piece, but I think this is where all the money is made. Finding a deal, raising the money, that's all the big stuff most people think about. But when it comes down to it, you need to manage the property. You need to have weekly calls with your property management company, and you need to implement systems to hold them accountable. You need to have frequent visits to the market to check in on the progress of the property. So this is a really big piece, and you need to have KPIs, which are key performance indicators, and different metrics to hold your property management company accountable. How are they doing on turning the units, leasing up? How frequently or how many leads are we getting a week, and how many of those are being converted into actual residents who are staying on our property? How's our online reputation doing? How many leads are coming from online to walk in, and all sorts of things like that that go into asset management that you need to make sure your deal sponsor or general partner are on top of. Next thing we do is provide reports to our investors. Gary and I provide monthly reports when we send things out to the investors, and those reports will generally have a high overview on a monthly basis, and then quarterly we'll send things like the rent roll and the financial statements. But typically we'll review things like, current occupancy, current pre-leased occupancy, different things going on at the property, any pictures of renovations going on, any exciting news going on, and things like that. And then we also send out checks quarterly. And then also the last thing here on the list is handle disposition, which is essentially the sale of the property. And, those types of things include working with a broker to best position the property for sale, understanding the current market conditions to ensure the best sales, that you get the best sales price. All right, so what is a passive investor or limited partner? And that's on the other side of a syndication is, you need two types of partners here in a syndication. You need a general partner who's leading the deal, and then you need limited partners or passive investors who, help bring the deal together and get it to the closing table. So a passive investor is simply an investor that has limited voting rights and limited responsibilities. So, you'll invest in a deal and you sit back and essentially collect your mailbox money. And it may seem a little bit too good to be true, but it is true. But really, the key thing for limited partners is to make sure you're choosing your sponsors wisely. You're spending the time up front vetting them and being sure they're the type of group that's going to do the right thing and that they have solid experience in what you're investing in. A couple of the ways that you can invest into these syndications are cash and or self-directed IRA are typically the two ways that this is done. Something you'll want to speak with your CPA about is there are some better alternatives out there for people who qualify than a self-directed IRA. There is what's called a UBIT tax with a self-directed IRA, and if you can avoid that tax, it's definitely worth it. But they do only certain people qualify for those. So I would definitely reach out to your CPA and see if there's a way that you can do that. Next on the list is accredited and sophisticated, which are basically two types of investors that we take on as limited partners. And first, I'll start with an accredited investor, which is essentially a term defined as someone who makes $200,000 a year for the last 2 years and for the foreseeable future. If you're filing joint and married, then that number is $300,000, and or your net worth is $1 million or more, not including your primary residence. So for those of you that live in California, that's a much bigger deal because obviously a lot of people have a lot of equity in their homes, which has a large portion of their net worth tied to that. So you would have to deduct that for your net worth. The next one is sophisticated investor, and this one's a little bit of a gray area, so I'm just going to read you the definition that's online for it and then go into it a little bit. So this is someone who's considered to have a depth of experience and market knowledge that makes them eligible for certain benefits and opportunities. So for us, we like to see someone who can understand that there's risk involved in these types of investments and can, make good decisions and understand that there's risk and reward. What we don't want is someone who just graduated high school and they just inherited $2 million and they want to give $2 million to something they don't fully understand. We want to make sure people who invest in our deals understand from A to Z, the risks and rewards of everything. Next is liquidity on investment. So typically when you're investing in real estate syndications for multifamily, these are not liquid investments. And what we tell our investors is, look, if it's a 5-year hold projected, you can expect your money to be in there for 5 years. It's not something that you can just one day decide, hey, I'm going to pull out this money. I need it for something else. I need to get out of this. Now, that being said, you can get your money out of syndications under certain circumstances, but it's not something that's very, very easily done. Typically, the first 12 months, it's completely illiquid. And then going forward, you're going to need the approval of your sponsor, along with finding a person who is interested in purchasing those shares at fair market value that's been vetted by the sponsor and approved by the sponsor as well. So that's why we typically tell our investors that if you do invest in a syndication, this should not be your last, $50,000 or $100,000. This should be money that you're not tied to, that you're willing to allow to sit in the investment for the length of the hold. And then last thing for limited partners is you'll receive a K-1, which is typically, every year before March is our goal. And that will have everything you need from a tax perspective to hand off to your CPA. But typically from a limited partner standpoint, very simple, you vet the sponsor, you vet the deal, you invest in the deal, and then you sit back and you let the sponsors do all the hard work.
And that K1, for people that don't know, is so you own a piece of that property. And so if you invest 100,000 and you own 1%, your K1 will reflect that. And each year, based on well, certainly the tax benefits, but also the income or any potential losses, that's all reflected in that K1 as well.
Perfect. All right. So what makes a good deal sponsor? So there's several things that make a good deal sponsor. Good deal sponsor. And the one thing I would like to say is that you need to make sure it's a well-rounded sponsor. If the sponsor has one or two of these items, I'm not sure that that's good enough to have a really good track record and become a good deal sponsor. Now, multifamily real estate is a team sport, so the team can collectively have all these things. But I do think that every one of these boxes need to be checked when you're vetting a deal sponsor. You're investing your hard-earned money into these deals, and if one of these things is missing and they don't align with your values and your goals, then that's going to be an issue. And so you want to make sure that they check the box in all these areas and then other areas that you're looking for as well. It's really a personality match type of thing, and just certain people are not, they're not aligned with other people's investments, and that's okay. You need to find the ones that are good deals for you, not just for everyone. So first thing I would say is experience, and this doesn't necessarily mean they need experience in multifamily investing per se. That is obviously the best experience that you can have, but I'll give myself as an example. I've been in multifamily for 2 years now. We have a couple of properties under our belt now, which is great. But prior to real estate, I managed over 250 employees, 20 million in revenue, and my experience was heavily on operations, management, and logistics. And these things fit very well when it comes to multifamily. Once you close on a property and it's the asset management piece, that's what you're doing every day is, you're relying on, or you're focusing on the operations, you're managing the property management company, you're implementing systems to hold them accountable, and you're working with budgets, and you're driving income, controlling expenses, and really trying to make the property run at its most efficient level. And that's what I did before. So I think I would be a good example of someone who has experience outside of the field that can be related to real estate itself. But you want to make sure the person's experience is directly relatable to multifamily if it isn't multifamily itself. Next is a track record, and that kind of ties into experience as well. Do they invest in real estate? Are they a passive investor in other people's deals? Do they invest in their own deals? Do they have any operational or management experience? Someone could be an investor in real estate for 20 years, but have absolutely zero management and operational experience. And that's going to be a tough thing for that person to overcome once they close on a property, because, getting a property under contract and closing it is one thing, but managing that property and making sure it runs at the most efficient level is another. And again, it doesn't have to be directly connected to real estate, but it is probably something that you would like. Next, good communicator. So how is their communication? Are they responsive? Do they answer all of your questions directly, or do they beat around the bush? I think these are signs of a red flag if they're not being transparent. This is definitely a key thing. Something that I look for myself is, are they upfront and transparent? I think a lot of people will try and, paint a different type of picture if it's bad news, but when it comes down to it, telling the truth, being transparent, and coming up with a plan on how to solve an issue is better than beating around the bush. The other thing on communication is how often are they communicating? Like I said, Gary and I communicate on a monthly basis to our investors, and we also have phone calls with them as well. So it's not just via email. And then ultimately, you need to make sure your personality fits with the sponsor's communication and what your expectations are. If you expect to speak with your sponsor on a monthly basis or get monthly reports, and you only get a report twice a year, well, you're not going to be happy with that deal when it ends. So it's really important to make sure your goals align with the sponsor's goals. Next is team members. So who's on the team, right? So Gary and I are lead sponsors, but we have other team members on our team that help us with the deal, whether that's from asset management to raising capital to due diligence and upfront costs. And so it's really key to track those things and understand who the team members are. So you want to know, how do those people know each other? Gary and I have known each other for a year and a half now. And we've been working together for the last 9 months. And, every time we go to Arizona, we're together. So we're in Arizona in the market 3 times a month. What is the team's experience, and do they complement one another? Do you have 5 people who are all underwriters, or do you have 5 people who only raise capital? You want a good mix of team where, you have a couple of people who can manage the asset. You have a couple of people that can raise capital. You have a couple of people that have construction experience, maybe, and sales experience. So it's really important to understand who the entire team is, how long they work together, and how well they work together. Next on the list is due diligence on the sponsor. And this, in my opinion, is something that obviously very important, but you should be able to perform as much due diligence on the sponsor as you would like. And if at any point a sponsor does not allow you to do that, I think it's a huge red flag. We've had people, sit down and interview us. We've had people do background checks on us, and we've certainly had people ask for referrals and call other people who we've worked with at our past jobs and our, in our current business to talk about the type of people we are. And we're completely transparent and open with that. And I think it's important for every sponsor to do that. Now, that does not necessarily mean that if something is uncovered that you shouldn't invest with that sponsor. I do think that the sponsor should make sure that they're upfront with all those things. But just because there's something that you find doesn't necessarily mean you shouldn't invest with that sponsor, but you should definitely ask questions around it and get more of an idea of what you're dealing with.
All right. So the offering. So this is so important when you're, when you're talking about multifamily, and, typically deals are going to be, let's say, $1 million or more. You need the legal document that protects the investors and the sponsors. And the document is intimidating. You're talking, combine all the documents, well over 100 pages. So you might have heard the term PPM, or private placement memorandum. So that covers the financials, the management biographies, a detailed description of the business operations. It's so important when you're ready to invest. You got to read these over carefully. It's a lot of pages, and a lot of people. It's a hard read, but it's important. You also have the operating agreement. Our operating agreement, that was 66 pages, so it's long, and that outlines the responsibilities and owners' percentages for the general and limited partners. You have the subscription agreement, which is the promise by the LLC, which is you create a property LLC that owns the property, and it outlines a specific number of shares for each LP at a specified price, and a promise by the LP to pay that price. So it lays out everything. You got the PPM, the subscription agreement, the operating agreement, and you really need to know your documents. Okay, fees. Now they range on different deals. So acquisition fee, I mean, sometimes I've seen 0 acquisition fee, but a really small split, and I'll get into splits later. But typically you're going to see 1 to 3, maybe sometimes even 4%. And so the size of the deal matters too. If you're talking about a 3% on a $10 million deal, that's $300,000. 3% on a $30 million deal, that's $900,000. So you definitely want to take a look at that. Asset management fee. So that's the general partners who are managing the asset. So Kyle and I are the asset managers on our Tucson and Phoenix property. So we get a fee of 2% of the total income that is made by the property over the course of the year. And our responsibilities are we manage that property, as Kyle said before, on a day-to-day, a week-to-week, or month-to-month basis, depending upon where we are. And it's definitely very heavy in the beginning as you take over, and particularly for the value-add properties. And then further down the line when you look to dispose of the property. Some people also charge a refinance fee. We do not do that. I know some people say, hey, well, we've done a lot of work to get with the lenders, and there's so much paperwork involved, but we don't do a refinance fee. we consider that really part of our asset managing. Some people also take a fee when they dispose of the property. Now, typically, that's when you're going to get, as a general partner, that's your payday when you dispose of it. But when you do have a disposition fee, it kind of incentivizes you to dispose of that property even more. So we don't like to do disposition fees. Again, you know, if the property does well and our LPs do well, then we will do well. So we don't like a lot of extra fees. You also have the construction fee. Typically, that's 5 to 10%, and that goes to the property manager who's managing the renovations of the units, if it's a value add or if it's a distressed property. For a new construction, you'll see that'll be higher, and that'll be probably from on the GP side, because there's a lot of work when you're talking about new construction. There's also the loan guarantee fee. Now, again, Kyle and I don't do that, but I've seen some deals where they'll take even like 0.1%. So there's a lot of fees that you have to pay attention to, and that's reading those documents and the fine print, and make sure you're not getting too many fees in this deal for the GP. Okay, splits. So we typically do, a 70-30 split. That means for the limited partners, they get 70% and the GPs get 30%. But I've seen, a range of new construction could be 50-50. Some deals for like brand new sponsors without any experience, I've seen like 85-15. So it ranges. So definitely pay attention to that. More complicated deals have a waterfall structure. So it might be a 70-30 split up until, let's say, 18% of an IRR, or let's say return on your money. And then it will go to a 50-50 split thereafter. So if the property does great on the sale, then the GP side will get rewarded more for that, because you've gotten a certain percentage back. There's also a preferred rate of return, or you might have heard it referred to as a pref. So that ranges. I've seen it from 6 to 8%. You can typically, the first year, if it's a value add, it might be, so let's say if it's 8%, like on our La Casa deal, the first year is going to be closer to 5% because we're doing the value add. Then it starts going 8, 9, 10. And also a big factor in that is your years of IO, of interest only payments. Once that interest only goes away, then there's a higher cost to the loan, obviously, because you're paying down principal. So your cash on cash might go down a little bit. So it's important when you're looking at a preferred rate of return, some GPs actually recapture that pref after the return on money. So you have to be careful on that. It's really important to know if in our deals, our investors get the pref, then they get the return on the capital, then we do the split. We don't recapture that pref. Then we have two key words, of or on: return of capital versus return on capital. Okay, so return of capital is if you invest $100,000 on a deal and you're getting 8% pref, that's like an interest payment. Okay, if it's a return of capital, it's considered paying back your money, and you don't want that. You want that coupon return. Okay, so return on capital is better for you. Okay, so time frame and business plan. So a flip, there are flips for multifamily, and it could be whether it's a 10 unit, a 20 unit, a 30 unit. there are still a lot of people doing flips on the smaller multifamily. When you're talking bigger apartment buildings, obviously it takes a lot longer to flip that property. When you're turning over units, you're improving the property. So a flip could be, let's say a year to 18 months, maybe even 24 months. So it's a short time frame. If you're purchasing a turnkey property, that business plan is, there's no value add to be had. It's ready to go. You're getting the keys, and you could put they typically put a renter in or renters in, and you're good to go. You don't need to do anything. You also have a value add. That's what Kyle and I typically focus on. So with our Tucson property, we added we're adding a dog park. We added a barbecue area. We painted the outside. It's a stabilized apartment building, meaning we have 80% more occupied units. So we can get a agency debt, which is great because it's long term, typically fixed. It's a low rate. When you're dealing with distressed properties, it's going to be occupied. It's going to be under 80%. So you have to do a bridge loan, and they're shorter term. They're higher cost, but certainly you could, there are distressed properties out there that you could make a killing on, but you got to know the difference. Core is that's almost like, it's like a dividend, kind of property. Very stable, low risk, lower returns. You typically don't need to do any upgrades. You've got that consistent cash flow. And also there's low debt on that. Core Plus is kind of in between core and value add. It's got growth and income. So you're going to do a little bit of upgrades, but not a whole lot. You've got a little bit more leverage, not as much leverage as value add, and certainly not as much leverage as distressed debt. And the less leverage you have lowers your returns, but obviously it reduces risk a little bit. All right, Kyle's going to jump into loans.
All right. So here's some of the things that you'll definitely want to consider when you're looking into a multifamily investment and understanding some of the key terms that are involved when it comes to loans. So the length of the loan. This really is a question that you should be asking as far as what is the exit strategy. Typically in multifamily loans, you can get loans from anywhere from ranging from 3 years all the way out to 15 years. They do have some that are 30 to 40, but typically they are shorter term loans. They're not like residential single family home loans. And so the exit strategy is really important when you're tying that in. If someone has a 5-year exit plan, and they're getting a 5-year loan, well, that's pretty risky. Because what happens if there's a downturn in year 4 or 5 and you can't sell the property? Now you have a balloon payment coming due. So you need to understand what the exit strategy is so that you can determine whether the length of the loan makes sense. Typically, we like 10 to 12-year debt so that if we do get into a situation where we go through a downturn, we can weather that storm. Really, I like to say is when you get hurt in real estate is when you need to sell at a given point, right? So if there's a downturn in year 5 and you have to sell in year 5 because you have a balloon payment coming due, that's when you're going to get hurt. If you can withstand the storm with value add, you're typically cash flowing pretty well by years 4 and 5. You hold on to the property and you don't have to sell at that point. You can make it through that downturn a lot better. Bridge loan versus agency. Gary kind of touched on this, so I won't spend too much time here, but this is two types of loans. There are other types of loans as well, like the local bank loans or CMBS, even credit union and life insurance loans, but we won't get into those. Typically, a bridge loan will be used for a shorter term distressed property where you're going to add a ton of value in the first 12 to 18 months, and then you'll go ahead and exit that bridge loan and turn it into agency debt. Typically, interest rates on bridge loans are higher, but the terms are better, meaning no prepayment penalties, more loan to value, things like that allow you to take a distressed property and turn it into a stabilized property. Agency debt is government-backed debt, typically by Fannie Mae or Freddie Mac. And it's definitely less flexible on the terms, higher prepayment penalties, but overall, I think you get a lower rate than a bridge loan, and it's a safer play overall, in my opinion. Recourse and non-recourse. So the big thing there is most agency debt is non-recourse loans, but you'll want to find out whether that's recourse or non-recourse. What recourse means is that you are signing a personal guarantee for your loan. So if you lose the property, they're going to be coming after your home, your cars, whatever you can think of. They're coming straight after you and all the money that you have. Non-recourse, what that means is that it's only tied to the property itself. So if you lose the property, they take back the property. They don't go after your personal items. You don't personally guarantee it. Now, there is what is called a bad boy carve out. So that means that if you commit fraud or do something illegal in any way, then that bad boy carve out basically eliminates the non-recourse and it triggers into a recourse loan. So just because it's non-recourse does not mean you can get away with anything. You still have to do everything in your power to operate the property at a high level. You have that responsibility not only to the lender, but also to your investors. You need to act appropriately or else it could trigger that bad boy carve out. Next thing you'll want to look at is a prepayment penalty. There's several different types of prepayment penalties. The two most common are the step down and yield maintenance. And step down is definitely more predictable. And I would say is a bit of a safer play. Basically, the way that works is that depending on the year you sell, depending on the length of the loan, you have a certain percentage prepayment penalty. So on a 10-year loan, it may look something like a 5% prepayment penalty in years 1 through 3. Then in years 4 and 5, it goes down to 4. And then years 6 and 7, it goes down to 3, and so on and so forth until it ends up being 0 in the last 6 months. Whereas a yield maintenance prepayment penalty is tied to the treasury. It's typically a much higher prepayment penalty. However, you do get a lower rate on the interest rate on the front end. And I won't go over the calculation on how to calculate yield maintenance because it's pretty in-depth and pretty confusing. But it's basically tied to the treasury, and it takes into consideration how much interest you would have paid over the entire life of the loan. So the earlier you sell it, the higher the prepayment penalty is going to be. So it's not that if you have a yield maintenance prepayment penalty that it's a bad deal, but you want to understand what the exit strategy is going to be in that scenario, or else you could get stuck with the property for a little bit longer. And the last item on the loan section is IO, which stands for interest only. And you typically see interest only for anywhere between 1 to 5 years. And what this is the length of time where the lender will require you to only pay the interest on the loan. So this definitely helps, like Gary mentioned, as far as cash flow in the first few years of a value add project. Not having to pay the principal, allows for higher cash flow. Especially in the years where you're adding value to the property, where it's not performing at a stabilized asset quite yet. The only thing on that is obviously you're not paying down any of the principal, so you will definitely have to pay that on the back end. Okay, market analysis. So after you've vetted your sponsors, after you've kind of looked at the deal, the next thing that you're going to want to go into is, what is the market that this investment is in? And I would say out of everything, it's important, but you want to make sure your sponsors is number one. That's the thing that you're betting on, is the operators. But then when you're looking at the market, these are some of the things that you want to go over. And the first one there is submarket. And the reason why it's number one is a lot of people just look at the market itself. Okay. And we'll just take Arizona, for example, because we invest in Arizona. And so they'll say, oh, Phoenix is great as a whole. I want to invest in Phoenix. Well, where in Phoenix? It'd be like, if you lived in LA, there's so many different places in LA. And just like there is in Phoenix, there's so many different submarkets within that metro that you need to understand, what part of Phoenix are you investing in? Real estate is hyper local. You can have something that is in a very good asset and 500 yards away, it's in another neighborhood that is a neighborhood that you want to completely stay away from. So you not only want to understand the market, but you want to understand the sub-market. And we even go down to the neighborhood that we're investing in, Gary and I, and understanding, what is the population growth of that area, not just of the overall market? What is the annual household income of that area? Where's the crime, poverty level, job diversity? All those things are important metrics, but you want to get down to the micro of it, not just the macro. And so all those items are very key. The other thing is that when you look at these items, you want to see what the trend is over the last 5 years. You can have a market that has good job growth compared to the nation. However, for the last 3 years, it's actually been on a decline. Well, that's a sign. Maybe that market is no longer a viable market, or maybe it's headed in the wrong direction. So I always say you don't want to take just a snapshot. You want the whole picture, right? You want to understand what the whole story is behind it, whether it's good or bad. There's a story, and is that a good story? Is the trend a good trend? So, crime, is the crime improving? Poverty, is the poverty improving? So on and so forth. And the last thing I'll mention on this slide is job diversity. I think that's key, where you don't want one industry controlling more than 20% of the market out there. So if you're in a market where, half the employees, 50% of the employees are based off of a military base or whatever it may be, then if that military base goes away, you've lost half your job force. And that's not a good thing. And so you want a market that can withstand, an industry taking a hit. And so that's, one of the many reasons why we love Phoenix and Tucson. All right, I am going to get into the key terms here, and I'll try and run through these quickly. Cash on cash. So this is the yearly return you'll make, which Gary called earlier is kind of the dividends. This does not include the sale of the property. So if you invested $100K, for example, and you receive $8,000 in the year in distributions, your cash on cash should be 8%. Okay. So again, that does not include the sale of the property. Those are just the dividends that you're receiving on a monthly or quarterly basis, depending on how the investment is set up. IRR, internal rate of return. This one's a little bit of a confusing one as well. It's not a straight calculation. The formula does get a little confusing, but the simplest way to take or to understand it is IRR takes into account the time value of money, where average annual return, which is just below that, does not. So for example, if you were to make 18% on an average annual return, you're making 18% year over year. But what IRR does is that if you make that in 3 years versus 4, your IRR is going to be higher because you did it in less time. Okay. Average annual return does not take into consideration the time that it takes to make that return. Okay. And so both of those calculations do take into account the sale of the property. So it's your dividend plus your return on the back end once we sell the property. Equity multiple. This is another way to look at your overall return. For example, if you invested $100K and at the end of the deal, the sponsor returned your initial $100K and also an additional $100K, which included your yearly distributions and the sale, your equity multiple would be 2x. Okay. And so some people do that as a percentage. So that would be 100%, and typically you want to look for something that's between, I would say, 70% to 100% or 1.7 to 2x. Debt service coverage ratio. This is a big one when you're dealing with the lender. This is also known as DSCR. And it's a number that the lender will use to qualify the property and to make sure it provides enough cash flow to pay for your debt service once the new debt service is put onto the property. Okay, once you buy it and have your debt on there. So typically the lenders, depending on the market, if you're in a tier 1 market, it could be as low as 1.2. And if you're in a tertiary market, it could be all the way up to 1.35. So an example would be if your debt service is $100,000 a year, so your monthly or your mortgage payment per se is $100,000 a year, and they're requiring a 1.25 debt service coverage ratio, the property would have to cash flow $125,000 in order for it to qualify for that loan. And if it doesn't qualify, what the lender will do is loan you less money, right? So those are called proceeds, and those will become less and less until you can hit that mark. But basically that number is what the lender wants, is to make sure there's room to pay for your debt and more just in case something were to happen. They want you to be able to get punched in the face a little bit and still be able to make your payments. Next is economic occupancy. Economic occupancy takes into consideration things like unpaid rent, concessions, bad debt, loss to lease, whereas the physical occupancy only takes into account actual vacant units. So if you have a 100-unit property and you have 2 vacant units and someone says, oh, we're 98% occupied, well, that's not going to mean much if only 50% of those people are paying rent, right? Because in that case, now your economic occupancy is actually 49%. So physical occupancy is important, but really the number you need to look at is economic occupancy, because you can understand how the property is performing and whether it really is stable or not. 98% doesn't mean it's stable. It's really about how many of those 98% are actually paying for the rent. Next, net operating income. So this is the income minus the expenses in simple terms, and is one of the main driving factors into determining the price of an asset and whether there's value to be created or not. So that is how we value multifamily properties, is based off of that NOI. Okay, and basically that's your bottom line prior to your debt service. So that does not include, that is before you're paying your debt service and setting aside any type of reserves or anything like that. Capitalization rate. So the formula for cap rate, which is another term for capitalization rate, is the total NOI divided by the current market value. And what this number tells you is what your return would be on a property at that given point if you did not change a thing, if it still had the same debt on it. Now, when you put on new debt, now all of a sudden it's a different cap rate because well, actually, no, I apologize. I take that back. It's not a different cap rate because it's based off of the NOI, but it's giving you what the property return would be at that given point in time. And then the last thing on here is the reversion cap rate. So similar to the cap rate, but what a reversion cap rate is an exit cap. So what multifamily syndicators need to do is they need to forecast out on their exit strategy what the property is going to sell for. And they do that by using what's called a reversion cap rate. And typically when you're looking at a reversion cap rate, you want to see something that is conservative. So, rule of thumb would be if you purchase at a 6 cap, you want to see a sales cap that is higher than the purchase cap. What we do, though, is we make sure what the market cap is, because you can get a good deal and purchase at a really good cap rate. And now all of a sudden, you're going to be affected by what you're selling it at. So what we do is take the current market cap, which let's just say it's a 5.5% market cap. That's what most properties in that size property and that class property is selling for. And then you want to see a reversion cap that is definitely higher than what the current market cap is at. And what's that saying is that the market, you're planning for the market to soften a little bit versus improve. If you're forecasting for a market to improve, then that's pretty aggressive. And so you really want to see something that is, at least you're forecasting for it to be softening. And then if you actually get a market that improves, well, then now it's kind of a home run type of deal, right? So we typically like to underwrite anywhere between 15 to 20 basis points per year of hold. So if you held it for 5 years, 15 times 5 is 75 to 100 basis points higher than what you purchased it for.
All right, so we threw a lot at you in the last 45, 50 minutes, but some of the key takeaways are you got to know who you're investing with. It can't be, sometimes you see a deal that's 20% return, 10% cash on cash, and another deal is 14% IRR and 8% cash on cash. That 14% IRR deal could be better than the other one. Do you know that sponsor? Do you know that, the things that we went over, go through that, do your own due diligence, because typically I'm not chasing, the numbers, because the numbers can always look good. No one's going to say, oh, this isn't going to do well, or this is going to be at 8%. I've never seen something like that. So really know your sponsor, do your due diligence, educate yourself. do your goals align with what their business plan is? Do you need that money back in a year, 3 years, 5 years, or not at all? You're not in a rush. Those are important things to make sure the business plan aligns. Hopefully you guys have a bunch of questions. We can you put them in the Q&A and we'll be happy to answer them. Let's see here. Well, if we don't have any questions, then we'll wrap it up. So maybe we did a really good job of explaining all these terms. But if you do have a question, don't be afraid to ask. We'd love to answer them for you. All right. Well, we thank you for joining us. We hope to we'll do this again back in January. We're going to take the December off. Hope you got a lot of value. The webinar will be available on Limitless Estates and Break of Day Capital's YouTube channels if you missed anything or want to rewatch it. If you'd like to learn more about Limitless Estates or Break of Day Capital and learn how you too can earn passive income while taking advantage of tax breaks, please reach out to us. We'd love to hear from you. Oh, okay, we got a couple of questions here. Steve asks, as deal sponsors, what have you found are the most challenging things to deal with? Kyle, you want to take that?
Yeah, sure. I mean, there's so many different things that happen during the course of getting a property, under contract all the way to the closing table. I think, from what we've learned, some of the challenges are with the lender. The lender is your biggest partner, but they're also the ones lending you the most money, right? So when they're lending you the most money, things can change on a dime because they control the deal. And so what you want to do is make sure that you're as transparent and as upfront with the lender as possible. And you need to open up those clear lines of communication because things can change on a dime. And one of the things I was talking to our lender about was, what can we do better to improve next time? And the thing he said to us was, look, every time he asked a question, we just got him the answer. We didn't complain about why he was asking that question or, why do we have to do that? We're not doing that. We weren't fighting or pushing back. So the thing that's the most challenging is dealing with that stuff. But at the same time, you've got to understand they're lending you 75 to 80% of the money. So they have every right to ask you those questions. And you just have to work through them because, one day the lender can say, okay, we've got everything that we need to close. And then literally the next day it goes to committee and they have 10 more questions, vetting the deal, vetting the sponsors, asking you all sorts of things. And you just have to be ready to go with those answers and understand the deal enough to get those answers through.
All right. Well, I think that was it. So thanks again, everyone, for joining us. I already saw a couple people say thank you. Very informative. Oh, Teo, you have a question here? All right, we'll tackle another one here. How about raising money for your deals? Do you all have a team of money raisers? You build that investor list ahead of time, so it's a lot of work involved. That's why we hold our meetups and we go to real estate conferences, or you're talking about what you're doing wherever you are, not selling it, but just telling people, giving them the opportunity, because people always are looking for other ways to place their money. So that's how we do it. And Kyle and I, we don't use a team of money raisers. We have partners that bring something else to the table. There's lots of money raisers out there, but that's not a system that we use at all. We bring on people that we can use to round out the team if we need that. All right, so Teo asks, when is the right time for a newbie to invest in a syndication? That's a really good question. Kyle kind of talked a little bit about that earlier by, making sure this isn't, if it's 50,000, it shouldn't be your last 50,000 that you have. Because when you read the PPM docs, they're going to tell you lots of different ways that you could potentially lose that money. And there are some really bad sponsors out there, but you've got to make sure you have money to invest, that you don't need that liquidity. And you really got to make sure you have an understanding of the deal. And so that's, education, and also that trust with that sponsor too. Have you met them? Have you spent some time with them? What's their operational experience like? Check their history. That's so important. And when you feel good about it, you'll know when it's ready, and you'll be able to make that jump.
Yeah, I agree with Gary, and I think the right answer for me too is when you're no longer considering yourself a newbie. If you're still considering yourself a newbie, you're not educated enough, and that's okay. And there's several ways to get educated, but you really need to feel comfortable where you're investing your money. And all the things we talked about tonight are very important, but number one, you need to understand where you're putting your money, and you need to feel comfortable with it, and you need to fully understand what you're doing, and whether it's the right move for you at that time. And you're the only person that can answer that question. And so if you can't answer that question, then I don't think you're at the point where you're ready. It would be my answer. We do have one in the chat, or a couple in the chat too, Gary. So do you have a value add percentage cap related to the deal, meaning deal investment to value add spend is 20% too high? I'm not sure I fully understand that. Do you, Gary?
No, let me see.
Deal investment to value add spend. I mean, typically, Bill, if I'm understanding your question correctly, in value add, what we're looking for is, almost an ROI, right? So if you're going to spend $100,000, are you going to get 20 to 30% ROI on that? But typically, Gary and I look for investments where you can spend $5,000 to $15,000 a door to get to, that $300 or $400 rent bump. I'm not sure if that completely answers your question, but there's going to be certain types of investments like Gary talked about, where it's like a core plus investment, where it's a light value add type of investment, where you're not going to put much into the property. Maybe it's mainly operational, where you can improve it. And then there's other ones where you definitely need to put more money into it, where it needs exterior work, interior work, and things like that to get to where it needs to be. But it really is going to depend on the type of investment and the risk involved with it.
All right. And then was there? Oh, okay. Steve asked, will we be at the Multifamily Masters meeting in December in downtown LA? And yes, we will both be there. So that's on December 8th at 2 to 5 p.m. Pacific time. So if you're in LA, we'd love to meet you. It'll be a fun time. Lots of other investors and real estate people. So we're definitely looking forward to meeting you, Steve, there. And without further ado, we're going to end the webinar. Thank you very much again. And we look forward to communicating with you in the future. Take care. Thanks.